I'm Grant Walker. Welcome to Heads Up for Wednesday, the 13th of May. I'll be back with the last call for you today at 4. In the rural sector, according to the Reserve Bank, persistently low dairy prices are keeping New Zealand farmers under pressure, with about a quarter of dairy farms experiencing negative cash flow in the current season. The dairy sector, which produces New Zealand's biggest export commodity, is seen as a risk to the nation's financial stability, with low global prices for milk products weighing on cash flow, particularly for those farms with elevated levels of debt. Large deferred payments from last season's record payout have helped mitigate the decline in incomes, though the Reserve Bank still sees risks for the sector if prices remain low. The Reserve Bank said there is significant crossover between farms estimated to have negative cash flows in the current season and those with high loan-to-value ratios above 65%. About 25% of farmers, who account for about 32% of the sector's $29 billion in debt, are estimated to have negative cash flow this season as milk prices hang near 5-year lows and the outlook remains subdued. The bank estimates about 11% of debt is held by farms with high loan-to-value ratios of above 65%. The bank said in its six-monthly financial stability report it's likely that the number of foreclosures among these indebted farms will eventually increase if weak cash flow persists for multiple reasons. Bank losses associated with these foreclosures will be exacerbated if land values fall alongside weaker farm incomes. The Reserve Bank has previously cited concerns about the level of indebtedness among a core group of dairy farmers, with about 10% of farms accounting for a third of the sector's debt. The bank said these farms tend to have higher levels of debt relative to output, leaving them more susceptible to worsening sectoral conditions. The Reserve Bank said private lenders have a largely positive view on the long-term outlook for the dairy sector and have been easing credit conditions for working capital. The dairy sector's fortunes will be largely influenced by how much Chinese milk demand recovers after it tapered off last year, following a build-up of inventories in 2013. The bank said some recovery in global milk prices is expected in the 2015-16 season, although there is considerable uncertainty over the timing and extent of the recovery. Assessing the balance of these global forces is difficult, but there is a significant risk that milk prices will remain low for an extended period. In business news, South Canterbury Flour Miller Farmers Mill is selling its new sugar-free range of bakery mixes and low glycemic index bread mixes to bakeries and retail distributors in Malaysia. Chief Executive Grant Bunting says this follows the range's official launch at the Malaysian Food Connection and subsequent meetings with manufacturers and distributors in that country and Indonesia. National Sales Manager Matt Keys says response for the new sugar-free range has been greater than anticipated. It's come mainly from large industrial bakeries, which are seeking to differentiate their baked products and target a growing awareness around diet. Mr. Keys says, I expected to work with many of the in-store supermarket bakeries, but didn't fully appreciate the need to tailor some of our range for large automated plant bakeries. The product range is still in its infancy and has been developed with support from both Agmart and Callaghan Innovation. Mr. Bunting says the company's product development is aligned specifically with that of nutritional trends. He said the most relevant at present is gluten-free and reduced sugar consumption. While the company is mainly committed to production of commodity flours for domestic supply, up to a fifth is tailored to export. Mr. Bunting says we recognise the opportunity to create value not only in terms of farmers' mill itself, but also for New Zealand grain growers. He says demand for traditional proteins from New Zealand by way of milk or meat is well publicised, but what we're advocating with signs of genuine interest is that of a role for arable proteins. He says the immediate demand from Malaysia and Indonesia for what is still niche products could be worth up to $3 million a year. To today's RBA statement, the Reserve Bank Financial Stability Report is a 62-page heavy-handed hint to inland revenue. As signalled by NBR Radio earlier this week, the Reserve Bank is targeting property investors in the Auckland region. Such investors will have to have a deposit of 30% of the value of the property. That's aimed at all property investors in the Auckland Council area, with the exception of those investors building new houses. In a partially compensating move, the existing speed limit for high loan-to-value ratio lending outside Auckland will be adjusted from 10% to 15%, although the 10% will remain for loans to owner-occupied houses in Auckland with mortgages of greater than 80% of the value of the house. The measures will take effect from October 1, but in the meantime, banks are warned to keep within the spirit of the rules and not engage in a splurge of lending to beat the changes. The new rules are effectively an extension of the loan-to-value ratio restrictions implemented nationally from October 2013. Those rules were effective for a time, the report released this morning says, but that effectiveness is now waning, and in any case, the big danger to the stability and well-being of the financial system is the Auckland property investor market. The subtext of much of the analysis of the Auckland property market contained in today's report is plain. These investments are being made with the intention of selling for capital gain, and therefore the capital gain should, under existing Income Tax Act rules, be included in property investors' income and taxed accordingly. Many property investors already do this, and Inland Revenue has been going after those who do not with increasing vigour since 2007. Today's report stresses the risk the recent Auckland property frenzy puts the country's entire economic system under. And for more on today's report, go to nbr.co.nz.
NBR Radio with the Property Press. It's out now to show you around.
NBR Radio, Tuesday the 12th. I'm John Stewart, and I'm joined by Sally Lindsay in Auckland and Chris Hutching in Christchurch for Property Talk. Now, Chris, I think the thing that's been on your mind is the question of convention centres for Christchurch and Queenstown.
Yes, New Zealand's going to enjoy a glut of convention centres when or if they'll come to completion. Now, the one in Christchurch is interesting because it is going to occupy the major part of Cathedral Square. This is the plan anyway, the government plan, the government blueprint. They're going to build this massive convention centre in the middle of Christchurch Square, and it'll straddle across a couple of blocks.
And it'll straddle across the cathedral, won't it? What's left of it?
Well, pretty close. Anyway, there's been a delay in this, and this is a little bit mysterious because it was set down to begin during this year and possibly be completed within the next couple of years by the end of 2017, and it is not going to be. Now, NBR first learned about this, I first learned about this around about 6, 7, 8 weeks ago, and I reported on it, although it wasn't really picked up locally in Christchurch by anybody, where there had been a meeting of senior property managers from a number of different state agencies, including the hospital board, and my source revealed to me that they had been told that it was going to be delayed, and the story that they were given was that it was to do with the perceived industry capacity, or lack of, when Christchurch Hospital's rebuild gets underway very shortly. It's already started, bits of it, and that's a $600 million rebuild. It's been on the books for decades, but anyway, the government like to call it part of the rebuild, so that's underway. Now, these property managers were told that as a result of the requirements, the tendering requirements for this hospital rebuild, some of the other government projects like this convention centre were going to be put back. Now, the government no spokesman has ever explained properly why it has been set back, and in fact there was no statement. Our local Christchurch Press reported over the weekend that it was going to be delayed. They mentioned a government announcement. Well, it wasn't a government announcement as far as I am aware. It was simply a change to a website timeline without any explanation, and of course when us journalists went there and said, hey, what's this, what's all this changed, they came out with a fairly weaselly, mealy-mouthed sort of excuse about having to look at plans again, etc., etc. Now, a lot of people in Christchurch are not particularly enamoured with this plan. It's a bit like the stadium. The convention centre's going to cost probably $300 million. That was the cost 4 years ago when it first came out.
Well, it will have blown out from that, won't it?
It will have blown out a lot more than that now, John. Yeah, absolutely.
And it's ugly.
This is part of what we call a cost-share agreement, where the government and the City Council entered into an arrangement 2 or 3 years, 4 years ago now, almost, whereby it would be half funded, roughly, by government and City Council. And a lot of folks here are not happy about that because this is a great deal of money that has to be raised from somewhere. And one of the areas where they're probably going to raise it is through asset sales. And Christchurch people a group of Christchurch people, shall we say, have always been extremely strongly opposed to that idea. There are also a lot of questions about the value of a convention centre to the people as such, as opposed to businesses that might feed off it. Because as we all know, these centres do not make money. They need to be subsidised. There is the issue of operating costs. Who is going to pay for that? That does not appear to have been sorted out yet. It'll probably be the City Council, I would think, because you couldn't imagine that a government would continue to fund that. So there's a whole lot of questions about that. Also, how are you going to make this a busy and active sort of centre? Because as we all know, convention centres, when they're not having a convention, are huge dead areas. So this thing is very much up in the air, and at the moment we're not really quite sure what's going on, and nobody is telling us. That is, nobody who is actually in the know. So that's the situation on the Christchurch one. There is an interesting development in Queenstown over there one. We have a private developer called the Porter Brothers. Alistair Porter is the spokesman for that. They have the Remarkables Park shopping centre and entertainment precinct out there on the outskirts of town by the airport. And they've said they will build a convention centre, and they don't want any ratepayer money whatsoever. They'll do it themselves, they say. They reckon they can do it cheaper, and they can make it pay better than what the council will. Now, the council wants to get one going in the centre of town. There's a whole lot of issues with that about who's going to pay for it and whether or not you really want all that congestion there, because the town has become aware that it's very congested. They're even talking about major parking restrictions for workers that come into town there. So the council at this stage is rejected Remarkables Park idea, and they're still pushing along with their own idea of putting up this convention centre in the centre of town. And Mr. Porter has said, well, okay, if you go down that path, you must be aware that this is a central business district plan that's going to benefit the central business district. It's not necessarily going to benefit us out at towards the airport at Remarkables Park. We should not have to pay for it. If you're going to go down this track, we're going to go for a judicial review about where the rating for this is going to come from.
Sounds like white elephants to me. I'm talking to Sally Lindsay and to Chris Hutching in Christchurch about property for our weekly spot. Now, thanks very much for that, Chris. Now, Sally, you've been studying the possibility of a study by the council on Ports of Auckland. Can you tell us a bit more about that?
On Thursday, the council's development committee will meet, which apparently is just the entire council, and they've got a future port study, and they've got it in a draft form from their own council staff. And so this is a year-long study, and at the end it will make decisions on what is going to happen with the port in light of all the bitterness and argument that's gone over the last few months over the two wharf extensions. So the report will look at relocating the port, the environmental considerations around the port being where it is, the Maori consideration on what they think of it there and whether they'd like it moved, and the costs and benefits and various options such as investment needed in Ports of Auckland, the infrastructure around the port, reconfiguration options, and the opportunity costs of having the land where it is as port operations.
All sounds pretty cumbersome, Sally. I mean, a lot of people are going to want to have their voices heard.
Well, there will be a lot of people. So the council is suggesting that the preparation of this report be handed over to the stakeholders, and then they'll have a smaller committee chaired by an independent chairman to look overall what these stakeholders say and somehow bring some sort of report together.
But they'll all have their own interests, which they'll be pushing, won't they?
Yes,
you just wonder how far it's going to go.
And there is a lot of scepticism that they can complete this report within a year, because there's going to be a huge amount of technical detail needed and costing and all that sort of stuff. And in the meantime, Ports of Auckland is just restricted in what it can do. And it'll be interesting to see if they win their court case on June the 2nd and then what happens from there.
Yeah. Chris, just back to you very briefly. EQC, they're getting a bit of a hurry up, or they're being given a hurry up, are they?
They're trying to give everybody a hurry up. They're saying that if you want to be in the managed repair program under Fletcher's, which deals with damage under 100,000, you've got to come to us by beginning of June, or otherwise we might cash settle with you. In other words, we'll just give you the money and say goodbye, go and sort it out yourself. A lot of people are not equipped to do that. They don't know much about building. They don't know, the sort of things that's involved. So some people are a little bit worried about that. At the same time, I guess you have to acknowledge that there are some people who are a little bit difficult to deal with and may have been delaying things. There will be many that will have justifiable delays because assessments are incorrect, wrong. There may be one or two just difficult people. Yeah. So that's the gist of what's happening there. And I guess to throw it back against EQC, while they're saying to everybody else, you hurry up and get on with it, they are still actually going through assessments themselves of whether or not these properties are over the 100,000 or under the 100,000. When they go over the 100,000, they have to hand over the case to the private insurer. So while they're saying to everybody, hurry up and get in this program or not, or cash settle, they themselves have been very slow in determining a lot of the assessments.
Yeah, classic bureaucracy by the sound of it. Sally, just finally and very briefly, you've stumbled upon a proposal by some Auckland councillors for a secret chamber.
Oh, yes, this is very funny. They had a secret briefing at the end of last year because they want to build a new chamber to hold their meetings because they can't be bothered walking 400 metres from their flash new offices in Albert Street to the old town hall and to hold their meetings there. Now, there's nothing wrong with holding the meetings in the town hall. Actually, it's quite a pleasant area. There's plenty of room.
It is.
And to build a new chamber, it was going to cost $1 to $3 million at the Albert Street headquarters. But they've decided that, no, they're not going to do anything about it in the meantime, especially when they're pushing a 9.6% rate rise on Auckland ratepayers, who were consulted about only a 3.5% rate rise. So they've dug themselves a bit of a hole there.
Sounds like it.
But whether they'll go ahead with it in future funding rounds, who knows? But what a ridiculous thing to do.
Indeed. Sally, Chris, thanks very much for Property Talk.
NBR Radio. With Clooney Restaurant now offering Auckland's most exclusive private dining room. NBR Radio.
In development news, Queenstown's Remarkables Park developer Alistair Porter has placed Lakes District Council on notice of judicial review over rating for a proposed convention centre. Mr Porter told NBR Radio the application for a review would involve the way any rates would be collected if the council goes ahead with its plans for a convention centre. Mr Porter's company, which has developed the Remarkables Park retail centre near Queenstown Airport, has plans for its own convention centre. Mr Porter says most of any benefit from a convention centre in the council-proposed central town site would go to central businesses and hotel owners. He said, we wouldn't ask them to fund a development at Remarkables Park. It's a matter of what's fair and reasonable. I sought a legal opinion, he said, and that was the gist of it. It wouldn't be fair and reasonable. The council would need to borrow $30 million with interest costs of $74 million over 50 years, supplemented by a government contribution. The chief executive of Queenstown Lakes District Council, Adam Feely, has described Mr Porter as a trade competitor and frequent litigant. His company has been involved in a range of issues concerning development around Remarkables Park over 2 decades. Mr Porter says he thinks the enthusiasm of central Queenstown businesses for the Council Convention Centre may be waning, especially as they enjoy higher occupancy and room rates. There are also many questions about how much convention centre activity benefits host city businesses because of doubts about how much delegates spend and the extent to which they displace other high-paying tourists. In court news, the wife of Christchurch businessman and property developer Graham Hazelwood has succeeded in constraining his funding activities. Susan Hazelwood appealed an earlier judgment to vary a stay of action she had succeeded in obtaining against Mr Hazelwood's company, Jeu de Vivre. The court action effectively gives Mrs Hazelwood development oversight of a Russley Road Christchurch property ahead of a substantive matrimonial property hearing. The court prevents Joie de Vivre from transferring the property to LNV Trustees, a trustee company of law firm Lane Neve, which has an agreement to buy it. LNV is trustee for the Boulder Trust associated with Mr Hazelwood. The court requires a proposed development loan of $2.5 million to be independent of Mr Hazelwood, and Mrs Hazelwood is to be informed of the lender's identity and other financial information. Several orders require Mr Hazelwood's undertakings not to remove LNV as trustee and related matters. NBR understands the couple are estranged. Back to the Oz budget. Australian Treasurer Joe Hockey has confirmed his government will impose taxes on digital imports and introduce measures to crack down on profit shifting by multinationals. Both measures were included in his second government budget delivered last night. The so-called Netflix tax will require all non-resident suppliers of digital importers to register for GST in Australia by July 1, 2017. Jeff Nightingale, head tax and private business at PwC, told NBR Radio they must be betting the Australian market is of sufficient size that non-resident suppliers will voluntarily register. It would be hard to force them. All eyes will be on the US-based Netflix, which currently charges its Australian and New Zealand customers no GST, making it the poster child for campaigns by Foxtel in Australia and Spark in New Zealand to level the playing field. Mr Hockey says the new tax on intangible imports will raise $350 million over 2 years, a drop in the bucket against the $35 billion deficit. Mr Nightingale says it's more about levelling the playing for Australian digital suppliers. His colleague, PwC GST specialist Eugene Trombaitis, adds, it's a line in the sand. Joe Hockey is saying if you've got consumption in Australia, it doesn't matter how it's purchased, we're going to tax it. Mr Hockey did not touch the Australian $1,000 GST threshold on physical imports, however. Mr Trombaitis says there's a will to lower the threshold, but for now it's being parked in the too hard basket while logistical questions are grappled with. It could be decided it's just not efficient to collect GST at below $1,000, Mr Trombaitis says, or at least not unless it's part of a multi-country initiative. The so-called Google tax measure will target multinational companies that artificially avoid having a taxable presence in Australia, despite having a significant presence in the Australian market. These multinationals will have to pay regular company tax rates. If it's deemed they've shifted profit to a lower tax subsidiary in another country, they will face a 100% penalty. Mr Hockey said 30 companies met this criteria. He did not name any, but Google, Apple and Facebook are among those regularly named by pundits. This morning, Revenue Minister Todd McClay had nothing new to add to his comments to NBR yesterday, which were in short that his officials are watching the Australian report closely. A report is being compiled with recommendations going to the Cabinet in a few months. The New Zealand government is waiting for the result of an OECD investigation into profit shifting, with an eye to ultimately taking part in a multi-country crackdown, according to Finance Minister Bill English. An OECD task force began looking at the issue in 2013. The plan is to get anti-tax avoidance measures in place by 2016 or 17. Australia says its Netflix tax and Google tax moves run parallel to that process. The same could happen here. Mr McClay says there are several technical issues to be worked through, however.
NBR. Need to hire? Try our online recruitment platform, www.nbrtalent.co.nz.
In business news, after more than 2 decades in business, Auckland waterfront restaurant Hammerheads has been forced into liquidation by Inland Revenue. Liquidators Craig Sanson and Colin McCloy have declined to say how much the IRD is claiming from the operators of the restaurant, which is located on Tamaki Drive. The restaurant closed its doors for the last time in late April on the eve of the High Court appointing the liquidators, who aim to sell the company's chattels and find a new tenant for the premises. Hospitality Association Chief Executive Bruce Robertson has suggested the closure is part of a countrywide trend that's seeing well-established hospitality businesses closing up shop in the face of new market entrants that are better able to meet customers' changing preferences. NBR Radio has been unable to contact Hammerheads owners Janine Ann Baker, Douglas James Neesham and Paula Marie Sheehan for comment. To the TPP, Democrats in the US Senate have blocked a crucial trade bill that would give President Barack Obama fast-track authority to expedite trade agreements through Congress. This is a major defeat for the president and supporters of the Trans-Pacific Partnership and other free trade agreements. The vote was 52-45, with supporters short of the 60 votes necessary to clear a procedural hurdle to advance the bill. But this is a short-term setback rather than an end to the story. Most observers believe a majority of senators support the fast-track measure as well as the TPP. The vote reflects political procedure practices as a group of Democrats try to tie the trade bill to 3 other trade-related pieces of legislation. These concern assistance to workers hurt by trade, a customs bill that includes workers' protections and language to push the administration to do more to combat currency manipulation, and one extending an expiring program that provides trade preferences to sub-Saharan African countries. The key figure in these anti-trade initiatives is Senate Minority Leader Harry Reid of Nevada, who has long campaigned for interest associated with organised labour. On the other side, Senate Majority Leader Mitch McConnell must regroup in an effort to get the extra votes necessary to advance the measure past the chamber's 60-vote threshold. A final vote at this procedural stage could be held next week. Passage of Trade Promotion Authority, which lapsed in 2007, allows the President to submit trade deals to Congress for an up or down vote with no amendments and runs for 7 years. To Auckland house prices, the median price of an Auckland house didn't change between March and April at $720,000, according to the latest figures released by the Real Estate Institute of New Zealand, although there has been a $108,500 or 17.7% increase in the Auckland median house price since April last year. The figures are the first to be released since REINZ reissued its historical series yesterday, significantly reducing its previously published path for house prices in the country's largest city. Where REINZ was previously saying the median Auckland house price rose 20.2% in the year to March, it now says that increase was 16.7%. However, the trend across Auckland was not even. On the North Shore, the median price was 6.9% higher in April than in March at $925,000, while the median in Auckland City was lower by 7.2% between March and April at $789,000 last month. REINZ Chief Executive Colleen Milne in a statement said the strong price movements in Auckland, particularly on the North Shore and in Rodney, continue to be driven by high demand from all types of property buyers and from a lack of sufficient new supply, both new builds and listings of existing properties. New builds take time to be completed. Meanwhile, the very low level of new listings suggests that potential vendors are considering factors other than just price in making the decision whether to sell their properties. Sales volumes in April reflected seasonal patterns, down 25% in Auckland from March, although they were 25% above sales last March. And the annual increases were even more marked for North Shore and Auckland City, with 53% and 44% increases respectively. Ms Milne says Auckland continues to dominate the real estate market in terms of price movements, but we're starting to see some of the smaller regions show improvements in the number of sales being made and price increases. Regions such as Northland, Hawke's Bay and Central Otago Lakes, which represent 7.5% of national sales, are seeing solid gains in both price and sales volumes. The Manawatu, Whanganui, Taranaki, Wellington and Nelson Marlborough regions all showed falls in median prices over the year to April of 3.2%, 4.9% and 1.1% respectively. The Central Otago Lakes region led the country with the median house price up 18.2% over the year to April to $532,000, although the median price slipped back 4.3% between March and April. Elsewhere in Canterbury and Westland, the median price was $425,000, up 7.6%, with the Christchurch median rising 6.8% to $440,750. The North Canterbury median rose 11.7% over the year to April. The Dunedin median was up 11.5%, while Otago region median rose 7.7% to $260,000.
NBR. With a National Business Review smartphone subscription, you can read or listen to the latest from NBR online. And for a limited time, it's free. Join NBR's Intelligent Business Network today and get free smartphone access to NBR online until August 31st. NBR doesn't do sport, weather or horoscopes, just timely, relevant, useful and insightful business news. So for business news you can use for free, visit nbr.co.nz/free.
I'm Grant Walker with Heads Up. Here's what's trending on NBR Online. The Reserve Bank targets Auckland investors. Low milk prices put a quarter of dairy farms into the red. We look at the Oz budget in detail. Auckland house prices stabilise, sort of. And flour miller finds niche market in Asia. If you're travelling today, Auckland finds spells very windy in Wellington, Christchurch and Dunedin fine. To find out more on our stories, log on to nbr.co.nz or stay tuned. Those stories coming up now on NBR Radio.
The UK election continues to spring surprises and offers lessons to pollsters and politicians alike. The parallels with New Zealand politics are intriguing too. In his editor's insight on Tuesday, Neville Gibson says there are two obvious comparisons with last year's New Zealand election. Neville, what are these parallels?
Well, the first one is obviously the polls and by implication the media coverage, because the polls totally underestimated public support for the government's economic achievements, and I think that was the same here. And so perhaps when the polling is about people's attitude to what they see in the media, but really what happened was you've got politics driven by pure wallet-driven politics, and people voted on that basis. And it's also interesting that in Israel we had a similar phenomenon, although I'm not going to draw comparisons with that. But again, there was a late surge there to the Prime Minister over quite different issues, but the polls didn't pick that up either. But the second one is Ed Miliband, and he struck me as very much being New Zealand's equivalent of David Cunliffe. He is pretty intellectual, far more left-wing than the public would probably like, and he was up against an affable and pragmatic politician, in this case John Key, and Cameron and Miliband provide the parallel there. And I think both polls have, not the polls so much as the elections, spell real danger to the Labour parties unless they move back into the centre, because in the UK, Miliband had a policy of higher taxes, far more government interventionist policies, and I think for Labour these are policies they'll have to look beyond and find other ways of expressing a desire for better social outcomes in the political scene.
So is the future of first past the post in the UK an issue for them in the future?
Well, that's an interesting one, and obviously we've gone past that and well beyond it, but there's a lot of calculations and commentary on it. Whether that actually gets anywhere in the next 5 years while the Conservatives are in power is highly unlikely, I think. But you've still got a large degree of people without a voice. About a third of the people still didn't vote for the Conservatives and Labour, and one calculation showing the spread of seats, if you did the proportional thing, shows the Conservatives losing 90 seats and Labour picking up Labour also losing around about 30, so you'd have a really hung parliament and they'd have to talk to each other. So I don't think the British public are ready for that yet, but I don't think that issue's going to go away either.
No. Now, the huge intake of new Scottish MPs, is that going to change things at Westminster?
Well, this is the really interesting one from a domestic point of view, because there's obviously going to be quite a lot of these new MPs are quite different from your normal MPs you get in the House. In fact, David Cameron said having a whole lot of these Scots in Parliament would be like a horror movie, but I don't think I'll be that scared. The thing is, the Scottish National Party has some very far-left policies. They won't be implemented, such as dropping the British nuclear deterrent. And Mr Cameron's going to be playing to the independence factor pretty strongly, because his promises for Scottish autonomy and independence within the United Kingdom include quite a lot of powers of taxation, and they may be sort of, hoist by their own petard if they have to actually raise more taxes in Scotland to pay for what might be a bigger welfare budget than what England and Wales and Northern Ireland will put up with.
So what's the future for other political parties in Scotland? I mean, we've got to bear in mind that Labour got a real trouncing in Scotland.
Well, you really feel for the Scots, because they've basically got a one-party system there, both in their own parliament and Westminster, because there's just 3 MPs going to Westminster who aren't members of the SNP. I looked for a bit of wisdom from someone there, and I went to T.R. Devine. He's now Sir Thomas Devine. He's written a trilogy of books on Scottish history for his view, and he says, well, you've got to look at it in 2 ways. One was the traditional Labour voters who didn't like Tony Blair. They deserted Labour some time ago to the SNP, and then more recently you've got Labour, the British Labour, opposing the referendum vote, and that's tarred them. So he says that basically Labour has been wiped out. He calls it the last bastion of unionism. So all you can hope for now is that the Conservatives, who've got 1 MP still, might see a bit of splintering in the views of the SNP as, say, more pro-business, pro-growth, more the right-wing element within Scotland comes to the fore.
Mr Cameron's most pressing international issue is the question of Europe. What do you think will happen there, Neville?
Well, it's definitely a more important issue, especially to us here in New Zealand, because British membership of the EU is really going to be at stake over the next 4 or 5 years. Mr Cameron's already met the French president and his Irish equivalent. What he wants are quite a lot of restrictions removed on British membership of the EU. He doesn't want to leave the EU, but he also wants the EU to cut down on a lot of its spending, some of its sillier rules. He's got this huge wing in the Conservative Party who aren't quite as extreme as the UKIP party, but he wants to get that deal sewn so that there's quite an acceptable British membership still within the EU before he holds this referendum, which he says is going to be around about 2017. So it's going to be pretty interesting to see how he handles his own MPs. And of course, as far as an opposition goes, like the UKIP, they've only just got one voice in the Commons, and that'll probably be a very quiet one.
Yeah, very muted. Well, thanks very much for today's Editor's Insight, Neville.
NBR Radio with Bayleys, New Zealand's leading commercial real estate company.
Let's look at the Australian budget. The federal government has produced a budget that's focused on encouraging growth in small business and jobs while rebuilding popularity among groups most affected by last year's budget. But it's also conservative enough to head off a possible downgrade in credit ratings. Generous subsidies will encourage small businesses to spend on big-ticket items, while extra childcare support will push more parents back to work. On the fiscal front, the deficit has widened by $3.5 billion to $35.1 billion, but Treasurer Joe Hockey has promised to return to a surplus within 5 years, which should ensure Australia will not lose its AAA credit rating. Moody's Investors Service says the budget has no surprises and is consistent with a stable AAA rating, while Standard & Poor's says the forecasts are broadly in line with its own expectations of moderate and declining deficits. As expected, the budget contains a raft of announcements, from a crackdown on multinational companies that send profits offshore to avoid paying tax, through to a 1.5% company tax cut and a $20,000 instant asset write-off benefit in a $5.5 billion package for small business. Mr Hockey says he isn't concerned the pickup of the small business package will be too great. He says this is about growing the economy. We want people to spend. We want them to go out and have a go. There are 2 million small businesses in Australia, and the budget is about unleashing opportunity. Taking effect from July 1, the small business tax cut to 28.5% is expected to benefit about 780,000 incorporated businesses at a cost of the budget of $1.45 billion over 4 years. To the market, shares of Newplex climbed 5% to a 13-month high after the specialty chemical maker lifted guidance for its full-year earnings on the back of strong performance in Europe, growth in its Asia and North America markets, and improvements in Australia and New Zealand. The company's shares rose 17 cents to $3.55, the highest it's been since March last year. The Auckland-based company now expects operating earnings before interest, tax, depreciation and amortisation to be between $130 to $134 million in the 12-month period ending June 30, up from its February guidance range of $115 to $125 and above the $125.7 million it reported in 2014. Newplex has been cutting back its operations in Australia and New Zealand, where a weaker performance is weighing on growth in Asia, America and Europe. In November, it sold its Australasian agency and distribution business, Newplex Specialties, and its plastic additives business, Newplex Masterbatch, for $127.5 million Australian, as it focuses on its global resins business. It used the sale proceeds to reduce debt and plans to buy back as much as 5% of its shares. Newplex said the lift in guidance came from a better-than-expected performance in Europe, as well as a turnaround in profitability in its Australia-New Zealand business, with sales margins improving. Newplex Chief Executive Emery Severin said Newplex's EBITDA to sales margin is ahead of management's forecast as a result of the benefits flowing from the global procurement program, lower raw material costs and group-wide lower operating costs. It's also due to the turnaround in profitability in the Australia-New Zealand business, where the EBITDA to sales margin has continued to improve following the restructure undertaken over the past few years. During the second half of the 2015 financial year, market conditions in Europe have been better than expected as a result of activity in the automotive, original equipment and manufacturing sectors. Asia and North America have been steady growth as expected. In Australia and New Zealand, as anticipated, market demand has been relatively flat. The company expects EBITDA growth across all its regions, with its Europe, Middle East and Africa region expected to lift earnings between 18 to 23% in local currency terms compared to a year earlier. Asia to be up between 15 to 20%, and the Americas to increase earnings between 5 and 10%. In court news, property advisor Propeller Property Investments has lost a court action to stop former contractors operating a rival business. Last month, the firm applied for an interim injunction to stop Trevor Moore and Michael Hackett from acting in competition for a year. However, Propeller's case did not wash well with Justice Mark Wolford, who ruled against the company funded by property commentator Nicky Connors. Mr. Moore told NBR Radio he's waiting out the appeal period to see if the case can go to arbitration and has described it as a festering sore he wants to get rid of. He declined to comment further, saying the decision spoke for itself. According to the decision, Mr. Moore was hired as a senior mentor and property strategist, while Mr. Hackett was a senior investment consultant. The duo had signed a restraint of trade saying that if they left, they would not compete with Propeller for 12 months. However, about a month later, they began working for Positive Education and Positive Real Estate, respectively. The former teaches people how to invest in property, while the latter is its real estate selling arm. According to the decision, Positive Education makes 90% of its revenue from a one-off fee of $9,995, which clients pay for lifetime mentoring. Propeller alleged this was working in competition against it and a breach of the restraint of trade. Ms. Connors gave evidence that Mr. Moore and Mr. Hackett were the core of Propeller's presence in the Auckland area, and the firm had invested significant time and money training them. However, the pair signed affidavits saying they had not attempted to solicit, divert or appropriate any clients or property developer relationships from Propeller. While the judge acknowledged the business was in competition, he declined an interim injunction to stop the property consultants. The judge said in his decision, there has also been no evidence provided of substantive damage to Propeller through loss of sales or in any other tangible way. The judge said it was going to prejudice the pair if they couldn't support themselves until the court case was over. Ms. Connors did not respond to NBR Radio's request for comment, and her lawyer, Scott Gaisley, was unable to comment. If you want to read the full decision, go to nbr.co.nz.
NBR
Radio.
Free to air online. NBR, the meeting place of intelligent business.
While you're sleeping, Wall Street traded lower, even as it erased some of its earlier losses, as rising global bond yields tempered the appetite for equities trading near record highs. Eurozone bonds have led the global climb in yields, rising from record lows in recent weeks as investors began questioning their optimism about a quantitative easing program launched by the European Central Bank in March. So yields on Germany's 10-year Bund rose 6 basis points to 0.67%. That compares with a record low of 0.049% set on April 17, according to Bloomberg. After losing ground early in the session, US Treasuries rallied, and that helped the US Treasury record a successful sale of $24 billion US of 3-year notes. In late trading in New York, the Dow Jones Industrial Average inched 0.06% lower, the S&P 500 fell 0.09%, and the Nasdaq slipped 0.08%. Last trading at 18,088.57, the Dow is not far off its record high reached earlier this year, and the S&P 500 is close too. In the latest economic data, the National Federation of Independent Business said its Small Business Optimism Index rose 1.7 points to 96.9 in April, the biggest advance since December. In Europe, the Stoxx 600 finished the session with a 1.3% drop from the previous close. France's CAC 40 fell 1.1%. The UK's FTSE dropped 1.4%, while Germany's DAX slid 1.7%. Greece's ASE index rose 1.4%. Back to the Australian budget. The deficit in the underlying cash balance for the 2016 year has widened to 35.1 billion Australian from 31.2 in the December update estimate, a rise of 3.9 billion. Citi says this is a result of the fall in key commodity prices such as iron ore lowering government receipts, low wages growth affecting income tax receipts, and an increase in some spending. This is narrower than the market's estimate of 40 billion. The forecast deficits out to 2018 are also wider when compared to the December estimate, also reflecting write-downs to receipts and more spending. Payments have not increased by as much as receipts have fallen over forward estimates. This reflects the redirection of previously costed funds. One example is the scrapped paid parental leave scheme and associated company tax cuts. Funds from this program have been directed to other initiatives and means that the cost of new budget policy measures is lower than would otherwise be. To some extent, this flatters the headline result. The budget's main goal is different to last year's effort. Whereas that was designed to curtail expenditure growth amid cries of a budget emergency, this year's effort is focused on re-engaging with disenfranchised voters. Big ticket items designed to win back support are in small business and childcare, no doubt crafted with an eye to the next federal election, which is likely to be held in the second half of 2016. The deficit is projected to improve more rapidly in 2019 to just 6.9 billion Australian, or 0.4% of GDP. What looks like being a very small surplus in 2020 comes from the recycling of old costed policies and cuts to spending and other programs further out in the forward estimates. The government could claim that it hasn't abandoned the task of fiscal repair, but is leaving little room for error. Another downward revision to receipts or requirement for more expenditure would push the fiscal repair task out further into the future. In business news, oil producer and explorer NZ Oil and Gas has been forced to can a planned shareholder meeting after falling foul of the takeovers panel. The company had wanted shareholders to approve a share buyback that would increase the holding of its major shareholder Zeta Resources, a Bermuda company associated with investor and Infratil director Duncan Saville. In a statement to the NZX late on Tuesday, NZ Oil and Gas said its notice of meeting had been withdrawn because the takeovers panel had advised it considers that the notice does not adequately describe the persons whose voting control may increase as a result of the buyback. The panel believes the omission is material information. Consequently, there will be no meeting on 21st of May 2015. In December, New Zealand Oil and Gas proposed a buyback of 64 million shares on market, an amount equivalent to 19% of its shares on issue. It said it was doing the buyback because its shares were undervalued from time to time, and a buyback would improve shareholder value for those who did not sell. The program would take place over up to 4 years. If Zeta chose not to sell into the buyback, its stake would increase from 19.9% to 24.5%. New Zealand Oil and Gas said it may reschedule a special meeting or seek the relevant approvals at the annual meeting later in the year. Zeta Resources, listed on the ASX, is 82.7% owned by Utilico Investments, a Bermuda-based investment fund managed by ICM, whose investment manager is Mr. Saville.
NBR Radio with Hotel de Brett. Open for breakfast, lunch and dinner and everything in between. NBR Radio.